Hello, everyone. Welcome to the July 18th edition of the Scientific Governance and Risk Meeting at MakerDAO. My name is Richard Brown. I'm the head of community development at Maker. We have a special guest today in the form of Alex Evans from Placeholder VC. We're anxiously looking forward to hearing from him. I'm anxiously looking forward to somebody trying to get me to understand exactly what was going on in that document that he shared, because it went completely over my head. So hopefully there'll be an it's playing like I'm 5 preamble for that. Otherwise, I'm just going to nod sagely in the background. I also want to keep things quiet as far as governance goes, because I don't have a lot to go over. And that's because there's not a lot happening in governance. There's a fantastic amount of things happening in governance. And all of that is going to be, we're going to be carpet bombing these meetings over the next couple of weeks of some presentations, some requests for comments, with some new forum debates about ways that we're hoping the community can come together and help us to optimize this process, because believe it or not, MCD is a real thing and it's coming soon. So we have a lot of work to do. This is one of the reasons why it's so hard for us to get pinned down for a date on when MCD happens, is because this is a 2-stage process. Basically, the first stage is the Maker Foundation puts all the pieces in place. Many people get all their work finished, and then the work depends on the community, and largely people that show up in this room, and the people that are showing up in the governance forum. But we have to rely on the community to help us do a great deal of work. We need to evaluate these assets. We need to talk about the processes and the policies. We need to talk about what the voting cadence looks like. We need to get piles and piles and piles of feedback, and for that to happen effectively, we're going to need to formalize and internalize some of the emerging process that's coming out of the forums, and that's going to happen over the course of the next few weeks. Too early to talk about now. So I've posted a few different links in the group chat. One of them is a discussion thread for this call. We'll continue the discussion there after this is ended. David will provide us with a summary of all the salient points. There's a link also to the thread for Alex's model. And there's also a link to something that Long for Wisdom, who's turning into a forum rock star for us, has been posting. I think, is this the first or the second? I'm not sure. I'm hoping it's the first of many.
I think it's one thread. It's one thread that he just updates.
Okay, so yeah, we're debating whether it's weekly or forever. So anyways, that's very valuable 10,000-foot view of what's happening in the forums, because the forums are taking off in ways that I can only have hoped for. Lots of really interesting governance stuff happening in there. Over time, we're going to find, I believe, that governance happens in that forum, basically. And then we talk about what happened in that forum in these calls, and we surface some things, and we prepare the community for signals, and we do some educational materials, but largely the heavy lifting happens in those forums. So if you haven't gone, I advise you to check it out. Tons and tons of valuable content. I'm hoping that I'll have enough bandwidth to get caught up with it, maybe on the weekend. I want to talk about very briefly about something I discussed in last week's meeting, and that is emergent process. We have lots of things to do. I've already touched on that a bit, but lots of things to do, lots of people that need to do it, and we need to figure out how that works. And happily, that's already been figured out largely, because we're not the first distributed team on the internet that needs to coordinate. We've been doing that for 30 years now. It's called open source. The tools are available. And so this is one of the things that I want to start discussing more and more about. How governance works, how these calls work, how the forums work, how the community development group in general works, and how that works is open source. The heavy lifting has been done here. So we need to start internalizing this idea of open source governance, which is something that we'll get into a bit more. But when it comes to the mechanics of how distributed teams of people work on the internet, especially in our space, it's all been nailed down. So people talk about things in forums, they talk about things in chats. They get together in GitHub, basically, for better or for worse. That's what we have. And then they do their work. They set up a project, they put in some issues, they comment on those, they submit a PR, and then that work goes into GitHub. And for our purposes, the distinction between Solidity code and a document, a framework, a model, a Python script that proves that model is a very thin distinction. So we're doing the same thing. So we have these tools available to us. So as we increase our efficiency in these calls or in the governance process, as we debate these workflows in the forums, we're going to get closer and closer to aligning with what the rest of the people in the space do. And that model, I'm hoping, looks like this. We have a few different venues, and those venues serve very clear purposes. We have a forum. A forum is where the debate happens and where input is gathered and where documents are initially drafted and hammered out. Once those documents are cool, we move them into GitHub, and then when they're in GitHub, they become an issue, and then that's the final process for adding people's inputs. So it's sort of like an EIP process. Once that document is finished, it goes into the PR gets accepted, it goes into GitHub proper, and that's where this GitHub becomes a document, a very loose content management system for us. It's a flat file document store where it's versioned, it's public, it has an audit trail, it has all of these things that we need in the governance space. And then once that has been placed in that canonical resource, anybody in the ecosystem is free to fire up Gatsby or any other tool to ingest that in their own websites, in their own portals, or in their own tools, or for whatever purposes they like. And so we have this cycle of requests for proposals, or a proposal comes out from some organization or group of people. Then we move into our request for comments phase, and then we move into this version control committing phase, and then we display that data in a presentation layer somewhere. We'll be digging into this a lot more over the course of the next few weeks, but just want to set the stage for that. I am going to stop talking very, very soon. So if you have a question, please type that question in the group chat. David and I, or I, will hopefully get to it in an appropriate moment. We'll ask that question for you if you don't have access to a microphone. If you have a microphone, please pipe up and ask a question whenever you like. Feel free to interrupt us. Or click on the discussion thread for this call. And if you want to have a deeper discussion, just add your question to that discussion thread, and we will dig into it over the course of the next week. I am going to stop there. And Alex, I think I want to potentially turn this over to you right away if you're prepared.
Sure, thanks for that, Mitch. So can you hear me?
Yeah, you can hear you all right. I should probably have formally, well, actually, I think I already did introduce you, but this is Alex Evans. He's from Placeholder VC. Placeholder VC, is that what you guys call yourself, or just Placeholder?
Just Placeholder. Just Placeholder. This is Alex Evans.
Placeholder.
Chris Berniski as well. It's a partner here at Placeholder. Placeholder is a venture capital firm that's crypto only and also a very proud and active NPR holder. And so as a part of that, what's that?
Sorry, I was just,
so I will, sorry, I'll take the screen. So I have to share screens because I put together some slides. So let me know when you can see my screen.
Yeah, looks good.
All right.
See it.
Great. So as I was saying, as part of our involvement with the Maker Network, we put together a risk model that we put on the placeholder.vc website, and is also now on the Maker thread, on the Maker forum. And so what I'd like to do in this presentation is to describe some of the thinking that went into that model, and also some of the core mechanics and assumptions that drive it, okay? So I'm gonna try to do that in 4 steps. So first, I'm gonna give a little bit of context and background. Then I'm gonna give a brief overview of the model and some of the assumptions behind it. Then I'm going to provide an example of how to estimate the parameters in the model. And then I'm going to give an example of how to apply the estimates from step 3 in a risk management example. Okay? So some context and motivation here. So now that I think about it too, I don't think there's a need for a lot of context. I think Cyrus, Vishesh, and some of the members on this call have done a pretty good job of setting the framework on what risk is, how we should think about risk, how we should model risk, what are some potential frameworks that we can use to formalize our understanding of our risk. So I don't want to repeat any of that. I think everybody here at least is aligned as we are and believes that the risks in Maker are significant. They are important, and that as community members we need to think systematically and rigorously about risk and debate the best ways to manage risk. And so there's ways in both the academic literature and in industry that we think systematically about risk and model it. Cyrus has done a good job presenting a good number of those models in the last couple calls. Maybe one thing that I can do here is give a little bit of color, and I apologize because we have noisy New York here in the background. So if you can't hear me, let me know. But why we chose a ratings-based model. And there's really three reasons why we went with this approach. And the first one is it just gels really well with the way that smart contract-based financial applications work and are architected, in that they're built on Ethereum, that's a state machine. And so they think about the world in terms of states and transactions representing transitions from one state to another. And what these models allow us to do is that they incorporate this idea of state and state transition very naturally and intuitively with very few assumptions. The second one is these models were designed historically for the types of instruments that have state-dependent payoffs. And so when we come to MKR, we really care about, let's say, how long a loan stays open, or whether a loan is bitten or is wiped or ends up in some other state. And so that is a perfect application of that kind of framework, because it's built for those kinds of derivatives and financial instruments that have these state-dependent payoffs. And then finally, these models are really adaptable and modular, and it's easy to change their assumptions without really messing too much up. So you can play with it and create new assumptions of your own and see what conclusions the model, how the conclusions of the model change depending on how you alter the assumptions. Okay, so without further ado, getting into what those assumptions are. So can you see everything on the screen?
Yes.
Yeah, looks good.
Yeah, I think there's that. Okay, so maybe that's better. So by the way, as I said in the last one, each of these assumptions, so I'm listing some assumptions here. Every one of these assumptions can be changed and can be altered. And in fact, I think it's a good exercise to try and go in and tweak some of these and see. So we can have really any unit of analysis here. We use individual draw transactions. We can have a discrete state space, continuous state space. This state space, a bigger one, a smaller one. Actually, in the next slide, I think I'll contract this state space a little bit. It can be Markov, non-Markov, homogeneous, non-homogeneous, and be continuous time, discrete time, or whatever. And so that's really one of the core intents of the model. So the way that this model thinks about Maker is, and I'll try to explain it as simply as possible. If you don't understand something, it's my fault, not yours, so please stop me. So the way this model thinks about Maker is it thinks about Maker as a collection of loans, primarily. And the way that we describe the global behavior of Maker is by looking at the emergent properties of that pool of loans. So the first thing that we need to do is that we need to find a model to explain and predict how loans will behave across time. Okay, so the first thing that we need in order to do that is we need to define what a loan is. And so that's what I mean here by unit of analysis. So here, a loan is defined as an individual draw transaction. So whenever somebody goes to the Maker contract and draws an amount of DAI, we call that a new loan. Now, there are other ways to model this. We do talk about some of the advantages and disadvantages of each of them in the actual paper that we have on placeholder.vc, where you could use CDPs or you could use DAI. I won't get into those trade-offs. You can go ahead and read about those there. But just remember that these are individual draw transactions. Now, just as if you've ever used a CDP, you know that when you create a new CDP or draw some amount of DAI, you're automatically in a safe state. And so your CDP is totally safe. And then at any given point in time, the loan could be in one of four states. It could be safe, where it started. It could be unsafe. In other words, it could be liable to being liquidated because it's below the 150% collateralization threshold. And then it could be wiped or it could be bitten. And so these two states, wiped and bitten, are what we call in this model absorbing states. In other words, if the loan is wiped or it's bitten, it can't go back to safe or unsafe. It stays in those states forever. You don't need to really worry about these Markov and continuous time assumptions here. They're discussed in the paper as well, but it's just important to remember that they exist and are important assumptions. Okay? So here in the top right, I have a diagram of the state space and the kinds of transitions that are allowed between different states. So you can go from safe to unsafe. You can't go from safe to bitten. You have to go through unsafe first. but you can go from safe to white. From unsafe, you can go to pretty much any state. And then you can go, once you get to white or bitten, you see there's no arrows leaving those states. That's because they're absorbing. So up here, what these aren't transition probabilities, as some people that have seen discrete time Markov chains would be familiar with. They're what are called transition rates. And what these rates allow us to do, they incorporate a notion of probability, the probability that you transition from one state to another, but they also incorporate a notion of time. And the reason for that is we actually really care as MKR holders and as community members about the amount of time that a loan spends in a given state. Right? So if a loan closes having been open for a month, that's very different to it closing after it being open for a year. Presumably in the latter case, it accrues significantly more stability fees. So hopefully that's clear. Here, right below, we describe how these different transition rates are calculated. So first, they're organized in this matrix called the generator matrix. It's just a convenient way to organize the information. That's the best way to think about it right now. So here we see, for example, the rate from safe to unsafe is this QSU, from safe to white, it's this QSW. And the way these are defined is the diagonal elements. Oh, and by the way, white and bitten are all zeros, right? Because there's no notion of transitioning from white to unsafe, for example. And so that's zero. So the diagonal elements are just the sum of the elements in the row corresponding to that diagonal element. So the transition rate out of the safe state, which is what this first 1-1 entry is here, is just the sum of the transition rates to unsafe, white, and bitten. So the transition rate out of safe is the transition to, you can only transition to 3 states. And so the sum of those transition rates is that transition rate you get here. It's just convention to do the negative of it, but really if you ignore the minus sign, that's the transition rate out of the state. So these off-diagonal elements incorporate this notion of probability. And so you take the transition rate out of the state and multiply it by the probability of going to, let's say, the unsafe state, and then you get transition rate from the safe to the unsafe state. Is that clear? Does that make sense?
Yeah, I have a quick question. So from the state change from unsafe to bitten, that is QUB in the flowchart on the top, but on the in the matrix it's QSB.
You're paying attention. That's a
QWB, yeah.
Yep. So that's QUB. You're right. Thanks.
Okay, cool.
Yeah. So that's just a typo. What's interesting here is that from the unsafe state, you could wipe it as well, and you could bite it as well. And actually, these transitions do occur in practice. We do see loans actually doing this oscillation a lot. That's just a side note.
Are you dealing with safe to bitten at all? I mean, I think you said you were going to ignore it, but I also noticed you put a spot for it in the matrix.
Yeah, so there is a spot for it, safe to bitten. Technically, and we note this in the paper, also very, very good question, this should be 0. Now, the reason I keep it here is because if you look at larger time intervals, it might show up as like,
right,
something goes from safe to bitten, but actually it went through unsafe, but you're just not noting it because your time interval is too big. So I keep it there for that reason. That's a really, really good question. Anything else? Okay. So how do we use this model? So one of the ways, and I didn't mean to just scare you with all these formulas here, so just ignore them. I want to note just one thing with this slide is every single one of these formulas that represent either global or local states, you can compute with just these 6 assumptions. And actually, just as Cyrus just noted, it's actually 5. You only need to compute these 5 rates. And then anything here you can compute directly. So with individual loans, you know all these Qs, right? Because you have them from the matrix. And so you know the average time that a loan stays open is this thing here. I derive all these formulas, the proofs of how they are derived are all in the paper if you're interested. So the only thing to note is the parsimony of the model. With very few assumptions, you can say what's the average time a loan stays open? What is the probability that it ends up in? These P's are these things here. And then with additional assumptions about the birth process, i.e. the rate at which new loans are created and the expected size of each loan, you can now start to project things like at any arbitrary point in time t, how many loans should I expect to be open? Or in the very, very long run equilibrium of the system, at what level does the number of loans stabilize? Or what is the total liquidation fees between now and some arbitrary point t, like a year from now? How many stability fees do I get between year 2 and year 5? And you get that from this formula. here. And so each of these formulas is basically these 5 assumptions, these 5 rates that we had in the previous slide, and just these 2 extra parameters. So you can get really, really far if you get good estimates of these parameters. You can make pretty good predictions about other parameters in the system, whether they be local pertaining to individual loans and the risk associated with them, or global parameters that have to do with the overall state of the system. Okay, so how do we actually go about making these estimations? And I won't get into a lot of detail on the statistics here. 1, because there's a time constraint, 2, because it might be boring. There is a note in the model that includes some work that Vishesh has done with a Python code that estimates the empirical transition matrix from on-chain data. Here's another approach that is included in the R code that accompanies the model on placeholder.bc, and basically tries to use covariates to estimate the conditional transition rates based on different values of the covariates. So here what we've done, this O you might not recognize. This O is just we're fusing the state space for safe and unsafe and just calling it open. So everything that's safe or unsafe, we kind of just treat as one and we call it open. And then so we just have 3 states, open, wiped, and bitten. That just simplifies things. It's not necessary that you do this, but it's just a way to convey the insight a little bit more clearly. And so here we just need to estimate 2 transition rates, and then everything else kind of falls out from those. So we have this open to bitten transition rate, and we estimate that conditional on the value of this covariate for the collateralization ratio. And this is a factor variable that is coded 0 if the collateralization ratio is above 280%. It's coded 1 if it's between 250 and 280, and then it's coded 2 if it's below 250. And so the assumption being that as the collateralization ratio increases, the rate at which loans are bitten also increases. Similarly, we go and estimate this open to wipe rate, and that's estimated based on the stability fee. And so again, the hypothesis is as the stability fee goes up, more people are like, screw this, I don't want to keep my CDP open, and so they wipe it. Okay? And these, you can think of this sort of as a regression table. It's a little bit different. We go into some of the intricacies in the actual paper, but the idea here is, for example, with the stability fee, you see this 72.4 here, 72.39. So if we were to increase the stability fee by 100%, not multiplicatively, but add 100% to the stability fee by 1, we would see an increase. The model predicts an increase in the rate at which loans are wiped by a factor of 72.4. Which means that all the loans will pretty much be wiped out of the system within a day or something like that. And then similarly for open to bitten, you see, for instance, the rate of transition to the bitten state when the collateralization ratio is below 250% is 14.3 times higher, so significantly higher. Okay? So questions on this?
I have a quick question about the very bottom, the -2 times log likelihood. What is that?
So that'll get us beyond the scope here. You and I can sync offline about that, but it'll just tell you the type of fit that you're getting here. So you're doing a partial likelihood basically across these ones. That you can think of it almost. It's not quite an R-squared because you need to do the standard errors for these, but anyway, it's reasonably good. There's some, here you also see 95% confidence intervals. I'm not getting into some of the stuff here that could be fun. There's more discussion of this in the paper and how this all works for, these are 95% confidence intervals, and then you can also pull standard errors for each one of these and do various things to understand the goodness of the fit. But I won't get into that here if you don't mind, David.
Yeah.
All right, but good question. Okay, so what can we do with this? So one application of these is in risk management. So what's great is Cyrus has already done all the hard work of explaining all this. So Cyrus has explained expected losses, unexpected losses, and so forth. Here we focus on what's called the conditional loss distribution. So conditional on the values of the covariate, for a given pool of loans, what percentage of them do we expect to, for instance, be bitten, is what we're trying to do here. And this is what's called scenario stress testing sometimes. So let's say for above 280, we see this green line. So the probability of really, really small losses is small. Probability of large-ish losses all the way to very large losses is extremely small. You have this peak here, whatever this is, around 17. And that's probably, that one standard deviation in there. You get most of your liquidations happening. And then on the other hand, if the collateralization ratio is below 250%, you see that the probability of small losses is pretty small, but these quite large losses are pretty probable. And so you see this impact a little bit clearly here. The probability that your loss will be contained at the 60% level is quite small, but the probability that they are quite large, they're contained at the 85 is that they exceed that 85 is quite high. So that is that. That's all I had to talk about today. I want to say thanks. Vishesh did a lot of really great work here, not just on the data, but a lot of the ideas that went into the model. So huge thanks to him. This is just one attempt. I think it's just the first and most imperfect attempt at a community risk model. I really hope and believe that these will get better over time. I will be available to answer questions on these on the Maker Forum or reach out directly. I'm Alex H. Evans on Twitter. I think I'm also Alex H. Evans on the Maker chat, so you can reach out to me there as well. I'll try to make time to answer questions. And one other thing here is we at Placeholder will be putting together a little bit of a more formal risk discussion or risk committee that will include several. It'll be a smaller sort of forum, and we'll share some of the results from that as we start to do that, probably around the launch of MCD. And yeah, that's all from me today. Thank you very much.
Really quickly, Alex, I saw that Mateo Leibowitz had a question in the chat about how you define loss. Is it defined as a byte or is it defined as
this is just
liquidation?
Byte. Yeah, this is just byte here. Now, in order to get the actual quote-unquote loss, also a great question. Now, in order to get the actual quote-unquote loss, you have to have an additional assumption about what percentage of CDPs is bidden below what level. So you need to have a distribution over what's called the recovery rate. Okay. So of the CDPs that are bidden, how much are below 100%, and then also what is the recovery rate should they be below 100%, and then you can actually talk about dollar amounts for how much the MKR holders truly lose. That's a really good question.
Alex, were you guys able to do any research on potentially calculating those transition probabilities? And if so, can you talk a little bit about the challenges associated with that? Because I imagine it's probably not an entirely straightforward thing to do.
Right. So there's been some background discussion on this. So one, by the way, on GitHub, so we shared a GitHub page with both the code to run all of these and generate the results of the estimation and the graphs and also the data. So if you look at the data that Vishesh was kind enough to contribute, it also includes the collateralization ratios at byte of every loan that was bidden. And so if somebody were to do that exercise and try to do it well, that would be where I would start, because it'll tell you what the collateralization ratio of that given loan was. And so that is one way to do it. The only issue is you really haven't had under collateralized loans. And so all of that is kind of guesstimation. So you could try to project based on that distribution. Well, if we had a whole bunch more, like what is the probability that it ends up below a certain number? That's probably how I would do it. It's just we've been quite conservative in terms of collateralization ratios, and the liquidation systems work sufficiently well where we haven't seen great examples of that happening. And so it really is an exercise in conjecture.
Yeah,
Alex, what's this? Oh, sorry, go ahead. Sorry.
I was just saying, yeah, that's a great point on the guesstimation side. I mean, I think right now all risk models are in a state of trying to deal with the lack of meaningful historical data. And actually, I think one of the, well, I don't know if it's an intentional design choice or anything, but something that we should be looking for in design choices is what is the easiest way, or what is the easiest model that'll help us abstract some of those necessary guesstimations, as you like to put them, and put them into the model. Because that's what I'm trying to get at. So if we wanted to input some sort of manual or expert adjustment into this model, do you think is that doable? Is that something we can say that based on our understanding of the underlying collateral, or would you be more comfortable just using this purely for collateral types that have like years and years of historical data? So like, do you think this would work equally well for ERC20 tokens, or would you say this is better for security tokens and longer historical assets?
Well, the more historical data, the more you can extrapolate and the more significance you're going to get from your statistics. The other one is, though, for security tokens that may be a little bit different, and we haven't seen them used in DeFi as much, while with other tokens, we could, for instance, look at compound loans and how those have behaved over time and whether there have been liquidations there and how that system has behaved in response to it. So we could see some examples. Now, the data is really, really recent. And so, for example, if you look at the collateralization ratio, one of the reasons why it's a factor as opposed to just a continuous collateralization ratio variable is because really for each one of those numbers you have, your sample size is like 2, right? So you can't really do much. And so you split it into just 3 big buckets of collateralization ratio. That's like pretty low resolution, but it's about as good as you can do in order to actually get some significance and talk about some results.
Yeah, and actually something else that I was talking with Vishesh about the other day was that the transition probabilities, do you think they would be similar across different collateral types? Or, I mean, certain collateral types, they'd be completely different, right? Certain like binary type of assets where one day they're just going to collapse to 0 or whatever. But for a particular set of standard assets, do you think that those transition probabilities will expect to be the same across different types?
So the hypothesis here is that those transition probabilities and rates depend on 2 things. So one, they depend on the price paths of the collateral. You've done a really good job explaining, so I'm just taking this directly from your presentations. One is the price paths of the collateral, and the second is the borrower behavior associated with borrowing against that collateral. So do you behave differently when you're borrowing against a house versus when you're borrowing against ETH? And my hypothesis would be yes. Like that is, it's a different type of borrower with a different kind of mindset and different types of behaviors associated with that type of lending. And then secondly, the price paths of those 2 assets are very, very different. One is more volatile than the other and it's quite differently. And so as a consequence to the transition rates would be different numerically, their estimation shouldn't be that different because really the system cares about state, and it says, what state are we in right now, and what states could we be in the future? And so all you need to do as an analyst is step back and say, okay, what's the probability that we get to that state?
Okay, so this is where, sorry, was somebody saying something?
Yeah, sorry, I was just saying, can I ask a follow-up to that? Or rather a clarification, right? So to what extent is the relative rate between different states determined by behavior versus on aggregate the amount of liquidation you would expect a function of asset price volatility, right? So how do you separate behavior versus...
Again, because I didn't understand what you were saying.
Right, so how do you separate the effects of behavior of CDP owners, for example, rebalancing when asset prices go up or shoring up when they see liquidations? How do you separate behavior versus asset price in terms of this is something that happened with ETH or this is something that CDP owners tend to do? And so that's where I started to think about variance. Yeah. I mean, that's where I started to think about the relative transitions, between one state versus another versus the overall aggregate amount of liquidation, for example, that you would expect, right? So I would say that the total amount of liquidation you would expect would primarily be a function of that asset, but how much people shore up capital in their CDPs versus taking it out when asset prices go up versus down, I would say would be more standardized across different assets as more of a behavior function.
That's interesting, yeah. So sorry, was there a question in there?
I guess it was more of a clarification than a question.
Okay.
All right, there was some questions in the forum, Alex, from Patrick.
I'll go ahead and respond to them. A good number of them are in the paper. And
okay.
So
can I ask a question?
You may ask a question, Chris.
So we talked some in the process about how this can be applied to valuation.
I knew you were going to ask that.
Curious if you can expound on how it could be applied to valuation. Valuation of MKR.
You have to do this. So there is a brief note at the end of the paper talking about valuation of MKR. One of the ideas that I mentioned very briefly in the presentation is that this type of model is very good, and actually you see the original paper that it sort of derives from references this idea of derivatives with state-dependent payoffs, and that should immediately ring a bell because it sounds a lot like MKR. It's a type of, you can think of it almost like a portfolio default swap written on the existing loans where it collects premiums from that pool, and then should there be an issue, it provides a residual form of capital to capitalize any under-collateralized loans, okay? So that idea, you would have to have a way to figure out from actually traded loans with interest rates that are free floating, unlike Maker, to strip out the risk premia and then apply it to take the empirical transition matrix that we discussed in the presentation and turn it into the risk neutral matrix, and then based on that matrix, go back and compute what the true risk neutral price of MKR is. Now that's a theoretical exercise, as I say in there, because we don't have access to those free floating loans. One of the things that's interesting that this type of modeling allows us to do, and some of the models that Cyrus has been presenting over recent weeks allow us to do, is that actually the valuation exercise and the risk management exercise kind of converge into one thing, in that we're trying to think about how do we maximize our risk-adjusted return as MKR holders, and it turns out that the actual answer to that is similar to the answer to what is the best way to manage risk in this system.
So, wait, could you re-explain the information you're taking from the free floating loans, like the traditional? Can you expound upon that a bit? I didn't quite understand that part.
Right. So in the JLT paper, he describes this technique where you go out and you find traded prices for, let's say, different corporate bonds or corporate liabilities of different.
Right.
And you go back, and then based on those and the actual transition probabilities, you do this recursive procedure where you strip it. I won't go into the details of this. He describes it super well in the paper. And then you pull out these risk premia. And so you have this vector of risk premia that you multiply the empirical transition matrix by, and then you get basically what's called the risk neutral matrix. And the risk neutral matrix is basically the same thing as a natural transition matrix, but with risk neutral probabilities. And then if you take, for example, under the risk neutral measure, the probability, like all your discounted stability fees and liquidation fees, less whatever you're going to have to make up fees, then you have a value for MKR. Now that's a theoretical exercise because you would need loans that are extremely similar to CDPs, which don't exist in publicly in traded form right now. So you have to have, let's say if it's single collateral DAI, it can have to be 150% collateralized with ETH. They would have to have a keeper reward of a liquidation penalty of 10%. They would have to reward keepers by 50%, like all these things, right? So Dharma loans and compound loans are kind of similar, but they're not similar enough where you can make that kind of risk neutral argument to say, well, under the ways that the market is pricing risk in this scenario, if we apply that same risk premium here, this is the value that we get. We can't really do that.
Okay.
All right, thanks for that, Alex. There's probably a lot more questions. I'm not sure what your schedule looks like, but we need to get into Vishesh Analytics for the next 15 minutes. But if you want to hang out, maybe we can ask some questions. If not, we can bombard you in the forums. But thank you for that. That was enormously valuable.
Thanks a lot, Alex. That was great.
Thank you.
All right, Vishesh, are you ready to take it away?
Sure. All right. So just to bring it back to some numbers after all that theoretical goodness. So as far as the DAI price, so right now volume's trading at like 5.6 million. It's been considerably higher than that over the past couple of days. So the spread is kind of waffled around 98, 99 cents for the last few days. So I'll just touch on that. But I think the big picture is things are doing all right. I think quite a few people expected things to be going a little bit better, especially with the stability fee increase. So it's interesting for us to dive into a little bit more of the like holistic measures and what's been going on instead of just looking at like price and stability fee in the silo, because things can get a little bit oversimplified and actually by extension a little bit confusing if you just try to look at stability fee and price. So yeah, just to touch on, I mean, this has kind of been the trend over the past month or so, as things were hovering around, you know, $1.98, 99 cents. Then there was a bit of this dip just at the beginning of July and a slight trend down with the 17.5% stability fee increase and the 18.5% stability fee increase. It had started to look like things might be recovering. Then ETH decided to start to make some insane price movements. And so there was this sort of double overreaction. And I do kind of want to touch on this because this has been a topic in the chats for quite a while, is how did we get into this scenario, and like, is it actually a problem or is it a temporary state of being? And so with the 17.5% increase, sorry, with the 17.5% decrease, there was kind of initially this narrative that at 19.5%, the state of the system was too expensive, DAI was trading above $1 at times, and so the stability fee needed to be decreased. That was probably a bit premature, right? So with that initial increase to 19.5%, there was some temporary push up of the price, and then a bit of a strong overreaction with the DAI price trading above $1 for just barely a week. And so then it was two successive decreases. And so that's when you started to see, as I had mentioned at the time, more kind of variability. The price was a little bit looser, though it wasn't necessarily lower. And so you'd see a widened spread. I should show the volatility of this. But at the end of the day, that started to drift down with the ETH price movement. And so it wasn't necessarily that the 16.5% stability fee caused that decrease, but rather increased the sensitivity of the system to what was going on with the ETH price. So when there was sort of this sharp drop in DAI price for a few days, there was again a strong reaction by the community. Okay, now we need to increase the stability fee to 17.5%, and then again to 18.5% shortly thereafter, because in the span of 4 days, it did not look like there had been much of an improvement. And so this was, again, maybe sort of that same strong double reaction pattern that I guess is now emerging, which I would caution against, right? So if you make changes thoughtfully the first time, then you don't have to sort of scramble to unwind them the second time. That's one sort of governance feedback that I will give. The other piece is, so with the 20.5% stability fee increase, a lot of people were kind of confused that the DAI price didn't, you know, immediately shoot up over $1 and stay there, and they were a little bit confused as to what was going on. And again, the stability fee does not inherently fix the DAI price. It doesn't inherently bring the DAI price down. It just improves the sensitivity of the system to what's going on with leveraging behavior, and by extension, ETH price. So this, like, just increasing the stability fee to 25% is not inherently just going to bring the DAI price up, although, because what you effectively need is people to buy back that DAI, which means you need people to be willing to unwind their leverage. And the problem is, some people, given where the price of ETH has gone, may be unwilling to give up on their positions at this time, or they may have been liquidated out, and thus they don't have to buy any DAI because they've already been liquidated. And if those liquidations happen at sort of effectively lower DAI prices, then you'll have kind of missed out on some of that upward price pressure. So a little bit of a complex process with a lot of moving pieces, but at the end of the day, I think the takeaway is even with the 20.5% stability fee, it's going to take a little bit of time for this curve to slowly get pushed up with that buying behavior. So again, I would caution against these sort of strong overreactions. And just because, things seem fine at the 19.5%, stability fee because ETH has not been stressed in that time doesn't mean that it's necessarily time to lower the stability fee, and vice versa. If it was increased to 17 and 18.5%, it doesn't necessarily mean that price is going to recover tomorrow. You need actual movement in the trading volume. So
Vishesh, really quickly, there was a question in chat about this. So is Maker governance then forced to take directional bets on ETH price?
Forced to know is, I don't think the preemptive stability fee changes approach, which is basically what you're getting at, what's been discussed a lot, is necessarily scientific, is what I'll say. I mean, you could certainly choose to try to manage the system by guessing what's going to happen with the ETH price, but if you just try to manage to the level of confidence that you have. So what I'll say is, if you think that the system does not have robust enough transaction volume, does not have robust enough holistic health in terms of level of leverage, amount of sticky demand, amount of oversupply, then you should be more weary of having a lower stability fee. So I think the problem is not so much that you have to guess what ETH is going to do. I think the problem is you have to be mindful of how much you're opening up the system to fluctuations in ETH price based on things like the level of organic demand, right? So if you have a greater degree of oversupply, what that's effectively saying is demand is a non-monolithic concept, right? So demand is basically a curve of stickiness. And so if you have a lot of DAI that's been drawn out on fairly transient demand in terms of people wanting short-term leverage, you really should just count that as oversupply. And so when you have that oversupply, when people are ready to effectively dump that DAI at the drop of a hat, then you should be more weary about having a lower stability fee because one, you're either going to exacerbate that problem, or two, just be mindful of then if ETH goes and decides to make a significant price movement, you're sort of flapping in the wind and you're subject to whatever those market movements are to a pretty significant degree. But if your oversupply is really low, right, and you have strong transaction volume, you have a high percentage of transaction to trading volume, you have not as much outstanding leverage position that's ready to be closed out, then you can be a little bit more confident. And so it's again not so much about guessing what ETH price is going to do, but being mindful of how much you're exposed to it at any given point in time. And so this is part of why DAI's price will always fluctuate, right? And this is a topic that's been discussed for quite a while, is DAI is never going to sit exactly at $1. The goal of management of the system, as I see it, is to try to manage the system health so that when it does fluctuate, it's fluctuating within acceptable ranges. And so, again, it's not, if you try to move the stability fee every week to try to counteract every price pressure, you're going to be chasing your tail, and I think you're just going to propagate more degree of variability and thus likely more error into the system. But I think if you try to keep the system more stable and less subject to those fluctuations and facilitating less oversupply or less of that sort of transient demand at any given point in time, then you will, I think, experience more stability. So it's kind of a management choice and a level of awareness rather than trying to preempt behavior, I think. Because that's really hard, and I don't think you're going to do that successfully.
Thanks.
Yeah. So to talk about some of those behaviors, so this was just the ETH price. So for context, this really started to tank around July 9th, 10th, which, if you look at what was going on with some of the trading volumes, there was a decent spike then, and then a little bit of a dip, and then a huge spike a couple of days later. So this huge spike, although the ETH price was just sort of continuing to go down, was unfortunately, probably a lot of people levering back up, some other people selling, and we'll go over to the supply metrics to sort of highlight that. So this is shortly thereafter, like that same time frame. So what we saw was overall, zoom back out here just real quick. So overall, this supply had been consistently growing for quite a while, around that like 90 million, 92 million level. There was, a lot of these problems with DAI price, and stability fee was consistently increased. During that period, supply came down to like 82 million, and then the stability fee was lowered, as we just talked about, to 16.5%. And supply sort of started to grow pretty consistently, topping out, around 91, 92 million. That's when we started to have conversations about the debt ceiling. I think during this time period, there was an accumulation of a lot of that transient demand, a lot of that leveraging behavior, and what you should effectively call oversupply. And so that's where you started to accumulate some of this risk, which you're now starting to see the effects of. So that a lot of that transient demand kind of went away. There was some refinancing, there was some liquidation, there was some closing of leverage positions, and then unfortunately, ETH. I think had ETH skyrocketed, you would have actually seen a similar effect in terms of DAI stability and DAI price. So that's again another reason why it's hard to try to make bets based on what happens with ETH price, because strong movements in both directions can actually end up having similar effects. And so had the ETH price shot up, you would have seen a lot of folks cashing out potentially, but you may have also seen folks leveraging up. And so it can go either way, unfortunately. So yeah, with the 20.5% increase, that supply had started to come down, but not because I think purely of the stability fee. And this is where correlations start to become really difficult, because the stability fee was increased due to instability in DAI, and instability in DAI was due to ETH price. So if you try to sit there and just make the correlation of stability fee was increased and then supply went down, you might draw the wrong conclusion. So the supply went down primarily due to those exogenous market factors. There's probably 4 or 5 million DAI that was wiped during that time, but a fair portion of it was also due to what was going on with secondary lending platforms, and a fair amount of refinancing to Compound, for example. So it's a combination of first your supply was starting to go down with some liquidations, then you started to have some people refinancing. You did have some people, I think, closing out positions, just sort of giving up, but I think more so those people were probably liquidated out. And so the remainder are probably just sort of sitting with their positions. So this, and I think this, funny enough, ties into what Alex was presenting around those transition states, and as part of the reason, now I'm glad that model is out there, and hopefully people understand this concept a little bit better. As this stability fee changes, you see often a significant impact in what's going on with the circulation of debt. And so that's where the age of debt is pretty decently impacted by what's going on with the profitability of loans, the extent that refinancing is going on, the extent that liquidations are going on, et cetera. So, with the successive stability fee increases earlier in May, I'll just go back for context here. The age of debt had kind of consistently been rising, accumulating a lot of, and this tracks with the sort of unpaid stability fees graph. So consistently growing and outpacing the extent to which loans were being liquidated or paid back. Then, successive stability fee increases, that age starts to decrease fairly significantly. And then with the 16.5%, 17 and then 16.5% drops, that sort of started to stagnate. And then you started to see, with a lot of refinancings and the success of secondary lending platforms in this sort of May-June timeframe, you did see some decrease in the age of open debt. So a lot of that was new debt being created, yes, because the supply was also growing during that time, but also with some slight uptick in the age of closed debt was due to refinancing to secondary lending platforms. So a combination of factors. What's really interesting now is these two lines have kind of converged. So you've actually got a really interesting, slightly decreasing steady state. And I say slightly decreasing because the stability fees have now been increased, but only for the last couple of weeks. And honestly, there was far more liquidation going on in that time frame. So the age of debt will be a little bit quieter during time periods like that. And so these two lines have kind of converged, where roughly the age that debt is open and the age that it is closed is roughly at the same level and slightly decreasing. So to kind of touch on what that looks like in terms of draws, so we saw a spike in draws around the end of June, and we saw a fairly heavy rising amount of draws in July, and so but a lot of that was on existing CDPs, and so this percentage of draws on new versus old CDPs has been relatively constant but slightly decreasing. So the effect of that on collateralization ratio is pretty interesting, and I actually next time I want to graph this against the ETH price so you can see the impact, but basically as the ETH price and we went over this, last week, the ETH price, when it goes down, you see a decrease in collateralization ratio, but then also a commensurate increase as this counter behavior. And so what's really interesting is right around this end of July time period, you actually had a fair amount of collateral being added after the dip. And so this is exactly what we're talking about, sort of that counter effect. A lot of people got scared from those liquidations and that drop in ETH price, and so have actually added collateral into the system, bringing up the collateralization ratio a bit. So as far as secondary lending platforms, and actually I'll just jump over real quick. So this is something that we kind of touched on, is transaction volume. So the quote unquote demand and the extent to which DAI is moving around, why it's moving around is an important question. So I've been asked this question from quite a few people, is how is the transaction volume of DAI versus the trading volume of DAI? And so you saw sort of these graphs on trading volume, right? So a huge peak in June 26th and like roughly July 14th, 15th to the tune of like 14 million and 8 and 9 million. But if you look at the total transaction volume on chain, that's more to the order of 140 million. And so this is, and I know Matthew had asked me this question on one of the chats, was it a record? Just shy of a record. So November 2018, 156 million was a record, but pretty darn close. And so you've seen this consistent rise in the transaction volume of DAI since basically the beginning of April. A lot of those secondary lending platforms had not really taken off in full force until May, June. So this is not purely due to smart contract activity on secondary lending platforms, although that definitely contributes. So I think the actual demand for DAI had been growing a bit and justifies part of the increase in supply. But I do think there was a fair amount of oversupply there in the last few weeks. The total transaction volume on DAI is partly attributable to that demand, and then partly attributable to DAI's usage in smart contracts, secondary lending platforms, refinancing DAI, things like that. So you can see the amount that DAI was traded, call it 14 million in the last few days. The amount that DAI was burned and minted, a total of like 6-7 million. But the total transaction volume, roughly in the 140s. And then the amount of DAI that was moved over from Maker to Compound was like roughly 5 million. So even taking those kinds of transfers into account, there's still a fair amount of activity over the past month. Bytes, so we saw, with those dips in ETH prices, there's a fair amount of of liquidations, but you know, again, nothing quite record-setting. It was just a 30% price drop. But with the way the collateralization ratio has been going, so this was something Alex touched on, is that liquidation percentage is hugely driven by what this collateralization ratio graph looks like over time. And even though things have kind of dipped and gone up, et cetera, just compared to the past, it's been huge. You know, almost double what it had been in the end of 2018, beginning of 2019. So that huge buffer of collateralization ratio is going to protect against a lot of those liquidations and the potential for under collateralized liquidations, et cetera. So I know time's going over, so I'm just gonna make one last point here, which is the borrow on secondary lending platforms has shot up with all this ETH price volatility, also partly due to things like the Instadat bridge and things like that, but also due to the stability fee. And so there's a lot of discussion around what's the natural role of these secondary lending platforms in this ecosystem. And you see the excess supply has consistently gone down over the past few weeks. And the utilization rate, I mean, DYDX is lower, but compound utilization rate is at like 93%. This makes total sense because to the extent that you can get cheaper DAI on secondary lending platforms, you know, there's no reason why people wouldn't do that. What's really interesting is as that excess supply dissipates, then you can actually say that the supply levels are closer to the organic demand levels, and you can be more confident that you have less oversupply. And so then when you start to talk about what the rates should be and whether the stability fee should be decreased, et cetera, I think these are really good indicators to look at. And I really want to caution against a lot of the, and I've been doing it for months, caution against the like oversimplistic thinking of DAI is down, increased stability fee, DAI is up, decreased stability fee. I think if we get off of that kind of narrative and we actually like wait more than a week before making changes, it will ultimately manage the system better. Okay.
Vishesh, there was a question in the chat. Is there a healthy amount of oversupply?
Healthy, so there's not a significant amount of oversupply now, I think. Had there been, or like, is it good for there to be oversupply? There was oversupply. Is it good? Obviously not. Healthy is complex. I think having a buffer on secondary lending platforms is a good thing in that it does help protect the demand function from a stability fee that is potentially too high. So there should be some buffer, but I don't, it's sort of like, you know, if you ask your doctor, should I eat more salt? The doctor's going to say you get enough salt in your diet. Like the excess supply, the oversupply is going to be high enough to give you like enough of a healthy buffer, I think, anyways, that you don't need to think about like artificially increasing it or anything. I think you generally want to manage it down, and then there will always be some amount that exists. If the excess supply on DYDX and Compound went to 0 tomorrow, then I would say stability fee is probably too high. You have no oversupply, and it's just, you know, bone on bone, and you probably should decrease the stability fee because there's enough demand out there that justifies a higher supply. Okay, I will stop sharing, but if there are more questions, I'm happy to answer. Yeah, so.
All right, if there's no questions incoming, sorry, Vishesh, were you going to say something?
No, I was just, you know, Matthew Leibowitz's question is, or his comment is right. That's effectively what I'm saying. You do want some access on those secondary platforms. But again, I don't think you have to try to increase it or anything.
All right, it's 7 minutes after the hour. That was a nice tight presentation from both Alex and Vishesh. If it turns out that there are more questions or people want to hang out and just talk about risk, We can do that for like the next half hour or so. But for people that want to drop out, I just want to say thanks Alex again for that great presentation. Thank you, Vishesh. Check out the forums, follow us. We're transitioning away from Reddit. As I said at the top of the meeting, governance happens in the forums, so please join us there. There's a lot of really smart people saying really smart things, and it's worth catching up on. And please join us. There'll be a summary of this call, and Alex's slides will be posted there as well sometime today. All right, I think, so I wonder, yeah, let's just hang out for a couple minutes, and if there's an awkward silence, we'll put an end to this thing. If there's questions, we can chit chat. All right, thanks everybody.
I have a question for you, Vishesh. Do you see a scenario where secondary lending platforms basically half the like effective DAI supply that would have been if they didn't exist at all? And like I'm trying to think of the right way to formulate the question, because like I look at Compound and it's a $20 million DAI market, right? That's a quarter of like the total DAI supply. So I don't know. I'm trying to figure out how to correctly ask what I'm trying to think about. But do you kind of get what I'm trying to say?
So are you worried that like secondary lending platforms are contributing to the supply?
No, that secondary lending platforms are, you know what? Let me think about it a little more, because I don't really know how to articulate it.
Yeah, so the one obvious like criticism or concern that I've heard is that secondary lending platforms are taking market share away from Maker somehow, and like the people are using those platforms instead of opening CDPs, and so forcing Maker into having higher stability fees, which again, as you can tell from my description there, I don't get how the argument follows, I would say. So if that's the concern, I don't see like a logical chain that brings you to that conclusion that they're taking market share away from Maker. I mean, to the extent that the rates are cheaper, and I think this is going to be an interesting point, is to the extent the rates are cheaper on those platforms, people will and should, and I think are now finally, waking up and realizing it, go to those platforms to obtain the same asset for cheaper. But the question would be, why does that supply exist on those platforms? And I think there are two different reasons why that supply exists. One is people who sort of capitulated their CDPs and sold their DAI and have no intent of reclaiming that DAI, at least for quite a while, or to the extent that people are holding on to DAI for some reason and have not decided to refinance. But I don't think that's I don't expect that to be a significant portion of the supply on those platforms. I think it will primarily be purchased DAI that is being supplied. But the borrow volume, is fairly significant. It's like 18 million. But as of 4 days ago, it was 11 million. And then as of 7 days ago, it was roughly that, and it hasn't changed, for quite a while. It was 7 million in June 19th. It's kind of been slowly and steadily increasing, except for in the last 4 or 5 days, which is again partly due to UI improvements, partly due to stability fee. But DYDX borrow volume, for example, has not is actually gone down a little bit, but is roughly.
So about DYDX borrow volume, is that because the people that actually use the supply DAI on DYDX are using it specifically for DYDX instruments and not just pure borrowing, like on Compound? Are you able to pure borrow on DYDX?
So I think you're going to start to see emerging use cases for different platforms, and so things are going to become more differentiated as they go. I think about a month ago, a lot of people would have asked the question of why would I use one platform versus the other, and what's the difference? But I think those are going to become increasingly differentiated. And so like DYDX, what you see is you see generally higher rates, although those have actually come down fairly significantly, but they're definitely more unpredictable rates. And you've seen the utilization come down pretty, and sorry, I'm looking at a graph here at Sunfair, but pretty like negatively correlated with compound compound utilization. And so what's interesting is compound may have taken some of the market share of DAI borrowing from DYDX. And I think part of the reason is education and UI. So UI is not to be underestimated, and definitely I think there were some people who were borrowing from DYDX at a higher rate and then realized they could get a lower rate on compound and decided to switch. That I'm sure is part of the impact. But also I think DYDX is in large part going to be used for like leverage long positions and for derivative structures. And so I think there were a fair amount of people who kind of given up on long positions and probably thus like disproportionately affected the borrow on DYDX versus other platforms. Because I think DYDX as its brand is going to be more used for more expensive, shorter term plays, or at least more unpredictable, shorter term plays that probably are for a greater degree of leverage, you know, like going directly 3x or something. I mean, DYDX, like UI-wise, has the easiest method of going, you know, directly to a 3x leverage long position. So compound, I think, is going to be basically the cheaper version of Maker, at least how a lot of people are going to think about it right now. So to the extent that supply exists on compound, it is going to get eaten up. But I don't think that's necessarily bad is kind of my point. And I think it is actually probably a net economic positive, because what was happening with that supply, you know, if it wasn't being borrowed on compound? It's not like people are drawing DAI out now to just go lend it on compound, because that makes no economic sense. If people are, that will go down over time as people smarten up. But I don't think that's a reasonable explanation of what's going on.
Right. Thanks. So that was a really good answer. There's another, there's a comment that I think is interesting by Cybele in the chat. He says, I'm concerned that the new 22.5%, which is the winning governance poll right now, is going to put on even more delayed pressure, and we're going to find ourselves in a supply crunch. So like, what if it goes up to 22.5 and DAI supply goes down another 10 million from 85 to 75?
Well, and this is the hard part. Yeah. So this is the hard part between like calls versus asynchronous chats and things like that, is we're moving so quickly that like some of this, I haven't had a chance to convey this on the calls since then, but like it's definitely been discussed in the chats that, you know, this idea of, okay, stability fee was increased to 19.5%. DAI is going to moon, yeah. I don't think that's an unreasonable guess. No, but if there is no oversupply, there's obviously going to be a supply crunch, obviously going to be a liquidity crunch on DAI. And so the price is very likely to move up. But the problem is, if that supply starts to decrease, and this is where I talk about quote unquote bone on bone, like if that supply starts to decrease because demand starts to decrease and people want to start using USDC instead of something else, that's when I think you should be concerned. And so, like, you don't want the stability fee to be 50%, because then you're self-selecting to where only people who are going insanely levered and are really into going levered on DAI would use the system. And that, I'm not sure that self-selection like selects for a very stable demand function. And so, like, I am basically cautioning against increasing the stability fee yet again. And I made the point prior that going from 17 to 18.5% happened too quickly, because going from 19 to 16.5 happened too quickly. And we're just like hyper overreacting in both directions. And we're going to get into a crazy loop, because then if you create a more unstable demand function where people are holding that DAI or putting it into leverage positions but are not necessarily buying it or trading it, maybe they're borrowing it from Compound or who knows what, then I think you could get into a scenario where DAI price is further depressed, and then people are like, oh, we have to increase the stability fee again. And that's like a weird sort of counter scenario to get into, where you create your own demons, right? So, and this is very hard to scientifically show, but like, to what extent is the current state of DAI, or for the past few weeks, a function of the reaction of what had happened to the 19.5% increase? And then like it starts to become a really complex like psychological equation of, had it been increased only to 19% instead of 19.5, would people have been less overreactionary to dropping it to 16.5, creating less of a need to increase it to 20.5 or 22 for that matter? And so it's like, you have to really visualize how these things play out, because you could create your own problems. And so I think the 20.5% increase was even maybe a little bit premature. Definitely now increasing to 22.5 would be premature. So yeah, I mean, Saibal has a point here, is this is the problem with governance. People could just decide whatever and not listen to anything I'm saying here. But data doesn't necessarily have to drive how people make decisions. I'm just suggesting what might not be supported by that data in the event that maker holders want to make scientific decisions.
Makes sense. Thanks. All right, I'm going to be hopping off the call. I'll see everybody later.
All right.
Maybe I'll hop off after Akiva's question, actually.
I think my prime fear is Rich paraphrasing me.
Yeah, right. So Akiva asks, will PEG get stronger as volume increases?
At the 20.5% stability fee, you've decreased the profitability of leverage transient demand on DAI. It is more likely than not than if there is significant trading volume on DAI for ETH, that would be buying volume. And so logically, yeah, it's more likely to improve the DAI price. Okay, so just like long-term you're asking? Yeah, I mean, obviously as transaction volume increases long-term, then you have a stronger demand function that can drive up your supply more sustainably than if you have lower transaction volume. So yeah, I mean, I think that's a pretty intuitive conclusion.
Does increased liquidity also increase the time delay of the effects of a stability fee adjustment?
Increased liquidity should, did you mean to say increase?
Yeah, increased liquidity. Like if the DAI market was way bigger, would the stability fee have a larger time delay or about the same? Or does the liquidity of the market have any like real modifying effect to that?
Well, presumably if you have more liquid order books, you would also have more trading volume. And so
Right.
if there's more trading volume on DAI and you have a higher stability fee, then again, presumably a bigger percentage of that trading volume is going to be purchasing. And so unless, unless the underlying asset is doing something crazy at the time. But what's important, I think, is as your transaction volume grows, as your order books become more liquid, more of those market impacts are transient and I think get processed by the system faster. And so they will pass. And then I think if they pass quicker, voters will be less likely to react to them or feel the need to react to them. And so the system will be stable for that reason.
That's interesting. Okay, cool. All right, bye for real. Take care, everybody.
Bye, Rich.
I think things are naturally winding down a bit. So maybe we can stick a fork in it there. Thanks everybody for your involvement. Thanks everybody to stuck around for the additional Q&A session. Final reminder, please check out the forums and get engaged. Lots of interesting things are happening, and this is the opportunity to have your say. All right, thanks everybody.